You coined this great term, vibe session. What is it, and are we experiencing it?
A vibe session is a disconnect between consumer sentiment and economic data. The stock market is up 12% on the year. Unemployment is at a record low. We're not in a recession. I do think we are in a vibe session just because it's a rather tense time. There's a lot of uncertainty. We're going into an election. Like, it's really hard to have quote unquote good vibes during that.
Kyla, where does this podcast find you?
I'm in New York City right now.
And you're at a WeWork with a fan in the background. Where's Adam Newman?
Yeah. Oh, he's not involved anymore. He's focused on real estate now, right?
Yeah, I've heard he's doing Flow or something right about this. Okay, so we're making an effort to bring in young influencers. I have a tendency to find people my age, boomers, who are on CNBC, and so you're one of our first outreach to someone we found. I think we found you on TikTok. Anyways, your new book, In This Economy, explores how money and markets really work. Walk us through what you believe are the biggest misconceptions about the U.S. economy.
Yeah, I mean, I think that's the issue is that a lot of everything's kind of misconception right now. I think a lot of people have a frustration with how the economy is functioning, like the labor market, inflation, etc. A lot of people think that inflation going down means that prices should go down, but we've been dealing with the pressure cooker of inflation, so everybody wants prices to go down. There's rolling recessions in tech and finance, so people extrapolate that to the broader labor market as well. So I think there's like a lot of misconceptions, and the goal of the book is just to be a toolbox to understand the economy. Everything that you need to know about inflation, GDP, like all the terminology and how it applies to you without, all the theory that goes into it.
What do most people get wrong about money in the markets?
One of my favorite charts is the chart from the Federal Reserve. It's called the distribution of financial assets. And it shows that the bottom 50% have all of their wealth inside of real estate, and the top 10% have their wealth inside of stocks and business ownership. And so I think a lot of people think that home ownership is sort of the path to wealth. And I think historically it could have been, but we kind of need to rethink what home ownership means, right? It's very confusing to have a house be both a speculative investment and then also a place that you need to live. And so I think that's kind of, it's not necessarily what people get wrong about the economy, but I think it's the thing that is most harmful is we view housing as the way to wealth when maybe it really shouldn't be.
But isn't housing to a certain extent? I've been thinking a lot about how to build wealth. And one of the observations I would have is that it is very difficult for people to build wealth with anything they can get their hands on. What do I mean by that? 99% of people, I believe, will spend everything within their grasp. And that's why these forced savings programs or options where you get one big lumpy hit or you sell a company, but big hits you weren't expecting, because regular cash in your hand is very hard to hold on to given all the temptations that's offered in a capitalist society. And to a certain extent, isn't housing sort of forced savings because people don't want to be evicted? So it forces them to make that kind of investment, some of which goes into equity in the home.
Yeah, yeah. I mean, I think housing is definitely one path for that. I think if you look at that chart, though, like the clear answer to how to build wealth, if you just are following the path of like what rich people have already done, is some form of stock ownership and some form of building a business, whether that be employee stock option programs or just actually building your own business. So I think housing is great in terms of like the forced savings aspect, as you've mentioned. But we have this expectation that house prices always go up. But like from 1860 to 1960, home prices went up by like 0.06%. And so I think I think we just kind of have a messy conception, and then it creates a lot of economic foreboding when people feel like they can't achieve the quote unquote American dream because it's the only way that they know how to build wealth.
I think that's a great point. Actually, Philip Schiller, the Case-Shiller Index, says if you take into account maintenance, that the housing market has not been nearly the asset class that people claim it is. In the book, you write, people are not static entities, but dynamic beings with evolving needs and aspirations, and growing economies should reflect that. When you look at our economy, what areas do you think need the most attention right now?
I mean, I think that we've done a really, really good job at focusing on manufacturing. The CHIPS Act, the IRA, the IIJA, all of those have really invested in American manufacturing and have enabled, like, fab factories to be built in Arizona. But I think like the big thing, and you've done a very good job talking about this, is like sort of putting young people on a path. I think that a lot of people feel stuck in their jobs or feel like they're not able to pursue, as you would say, their talent. But I think that's kind of where we need help. Is that we have a whole generation of people that are stuck. And the labor market is sort of funny. Like there are these rolling recessions in tech and finance. And so I think it's a reallocation of capital that'll enable new jobs to come out. I think that's what needs to be done. Yeah.
You coined this great term, vibe session. What is it, and are we experiencing it?
A vibe session is a disconnect between consumer sentiment and economic data. And I wrote this piece back in July 2022, and it turned into a New York Times opinion piece. And everybody kind of latched on to it because, the economic data was really good during that time. Like GDP was improving, the labor market was strong, inflation was going down, but people were still feeling really bad if you looked at sentiment metrics. And so that term is meant to capture that idea. And then since then, it's evolved to recognize like structural affordability issues. Like we have a housing crisis, childcare costs have gone up like, 32% since 2019 or something like that. Elder care is $10,000 a month. Education costs are sky high. And so, like, there are reasons that people feel bad. But then there's this poll that came out, sort of detailing, that 55% of people think that we're in a recession, 49% of people think that the stock market is at all time lows, or is down on the year, and that 49% also think that unemployment is at all time lows. And so, like, there's this aspect of the vibe session where, okay, yes, there is an actual disconnect between consumer sentiment and economic data. And some of that can be explained by structural affordability. And then I think another component of it is explained by a lack of media literacy. Like the stock market is up 12% on the year. Unemployment is at a record low. We're not in a recession. I do think we are in a vibe session, just because it's a rather tense time. There's a lot of uncertainty. We're going into an election. Like it's really hard to have quote unquote good vibes during that. I think another thing that I've been sort of thinking about is like there's this gap between online discourse and then offline discourse. So like air travel hit an all-time high over Memorial Day weekend. Like everybody's flying everywhere. People are out there spending money. You can see it in the consumer spending metrics. But if you go online, the discourse is negative. People are feeling very bad. And that's kind of the other thing too, is like there's this bifurcation between actual reality and then perceived reality through the online sphere.
There really is a disconnect. And then I look, people shitposting America, lowest inflation, biggest growth. The factors are strongest growth. And some of the factors that you talked about, do you think our discourse has become more coarse, or do you think, as someone who's just understands of your generation, what do you think is causing this? Is it a move to online where we have bots, trolls, a lack of civility? Do you think it's kids are more prone to, I don't know, being depressed or anxious because of helicopter parenting and social media? But what has created a situation where 55% of people my age feel very proud to be American, but it's only 18% of people under the age of 25?
It's really sad, and I think that that poll, and of course you have to take all surveys with a grain of salt, but that poll where, people think we're in a recession when we're not, they think the stock market is down when it's not, they think unemployment is really high when it's not. It's just like what's happening? And so I think a big part of it is the media that people consume. So younger people get a lot of their news from TikTok. There's a lot of surveys pointing that out, a lot of data sources. And like TikTok, the algorithm totally incentivizes you to post negative things. Like if you are saying that the world is ending, you're much more likely to get a million views than if you're like everything's perfect and good and you should be fine. I also think there's a pressure to be anxious. And I think like anxiousness is very normal. Like we do have a lot of information flow, but if you're not freaking out, it means that you don't care, right? And so, like, there's almost this performative anxiety that comes up, and that's a loaded term, but I do think that's what it is. Is like because I get yelled at in my comments too for not caring about the state of affairs. But like, there's an element of truth that you have to recognize when you talk about the economy. Like, you can't say the stock market is down when it's not. But if you're saying that things are good, people are like, "Well, you just don't care about anything. Like, you're just lying to us." And it really creates this strange environment. So I think it's media, the consumption of certain types of media, and then how you have to be perceived in the online world is in a state of anxiety.
What you're talking about, I'm naturally fits me like a glove because I'm a glass half empty kind of guy and, suffer from anger and depression. So I feed right into this zeitgeist. But whenever I talk about, just the exceptional performance of a stock or the markets touching all-time highs, I was like, well, typical boomer who, the real economy, most of us, Scott, don't get to invest in stocks. It's like you get shamed and you're sort of perceived as non-empathetic if you're not catastrophizing all the time and talking about the worst possible outcome for everybody. Speaking of this type of, I don't know, looking through the world with gray colored glasses, talk a little bit about dollar doomerism.
Yeah, I mean, a lot of people think that the US dollar is no longer going to be the reserve currency. That discourse hasn't been as popular over the past few months as the US has kind of gained traction in manufacturing and has been able to pass legislation finally. But yeah, people are kind of like betting on the downfall of the US by saying that the US dollar won't be reserve currency anymore. So you saw a lot of that kind of like post COVID, first few years after the pandemic. There was a paper from the IMF that refuted that and was like, no, like, it's not going to switch over to China or Russia as being the reserve currency of the world. It's probably just going to be, if anything, a basket of mixed currencies. But yeah, I mean, it's sort of going back to like what you asked about with like, why do young people feel so bad about like, why are they not proud to be American? Like, you can kind of see that through people being like, the dollar is not going to be the reserve currency. Like, that's a bet against the United States.
You brought up something, or you're aware of something that we talk a lot about here, and that is inflation and a lack of prosperity. We believe can be reverse engineered partially to concentration and the sort of oligopolization of our economy. Four companies control 85% of the U.S. beef market. Four companies control 80% of the soy market. Three companies, 78% of pasta. Three companies, 72% of the cereal market. I mean, this is more a comment than a question. I think you agree. But it appears that people aren't focusing enough on this. How else should we be thinking about this as it relates to inflation?
Yeah, I mean, as a Dr. Isabella Weber has written a really great research paper on this, sort of like how companies might be passing costs off to consumers through higher prices, and monopolies are like the key way to do that, right? Like if you don't have any competition, it's much easier to push prices through. And I think, like, to counter that example, we're kind of seeing that, McDonald's is lowering the prices on their food. Like, they're finally offering a $5 meal because companies like Domino's have had reward programs that people have been flocking to. And so that shows that if you do have competition within the corporate space, like, companies are going to respond and therefore lower their prices. But I think a lot of the pain of the consumer has been through, companies like Kraft Heinz raising prices, just putting a lot of like Nestle raising prices because they're able to. People have to buy the things that like Nestle and Kraft, well, more or less have to buy. P&G, they have to buy like paper towels and toothpaste. And so those companies, I do think, are responsible for some elements of inflation that we're experiencing. And then I think they're also responsible for the quote unquote bad vibes. Like when you like I go to the grocery store and I'm like, whoa, okay, like that was an expensive trip and I don't feel great about that and it sucks. And that like the grocery bill that you get and then the gas price that you pay are the two main ways that consumers interact with the economy. And so if corporations are able to, raise prices and do it without any thought other than profit, it can be very harmful to the consumer.
I love, just as we wrap up here, we're trying to be, we're purposefully, or I would say I'm personally trying to be a little bit more optimistic. And I write a lot about the challenges facing young people and how it warrants more attention and more investment, but also believe that as kids come out of, you know, commencement, that they do have agency. And I want to bring on more people like yourself that have demonstrated that type of agency. When I was getting out of college, I knew I was interested in finance and economics. You could either go to an investment bank and get into an analyst program, which is exceptionally competitive. You could become a stockbroker. I got my Series 7, and basically being a stockbroker was calling all of your friends' parents and asking them to buy stocks through your ridiculous fees. Or you could go back to graduate school and try and become an economist. I mean, there really weren't that many on-ramps to having influence in the markets. Can you talk a little bit about how you kind of your path and how you found agency and became, I hate to use the word influencer, became someone who is a strong voice in this and appears to be making a nice living and has developed a rewarding career. Talk about your backstory and your path to how you got where you are now.
Yeah, I grew up in Kentucky, and I thought I'd be stuck in Kentucky forever. And it's not a bad place to be. It just, there wasn't the opportunities that I wanted there. And so I went to school in Kentucky for the scholarship program that I was on, and all throughout college, I tutored in economics and had a blog talking about my options trading. And so I'd always been sort of in the online sphere. And then I went out to Capital Group in Los Angeles and worked on the buy side for about a year and a half. But 6 months after I graduated, COVID happened. And so, like, the way that I thought about work was, it changed quite a bit because all of a sudden you're faced with death. and you're like, "Oh, well, what do I really wanna be doing?" And for me, it was, education, specifically economics education. And so I started making videos around GameStop. And, a lot of things sort of influenced like why I wanted to focus on economics education. Number one is because I don't think we give people a fair shake at all when it comes to understanding the economy. Like it's something that we all exist in. Like I bought a coffee this morning. Like that's an economic transaction. The jobs that we have are economic, interfaces. Everything that we do is tied to the economy somehow, but we pretend that we don't need to understand it. We pretend that we don't need to know what the Fed does and how it influences interest rates. And we don't need to know the depth of it, but we need to at least understand how it could impact us. I think that it creates a lot of confusion and a lot of anger when people live in a system that they don't understand. And so I kind of set off, partly because I felt like I wanted younger Kyla to have access to this stuff. And, if there's a younger Kyla out there, I want to help her. But then I just think it's really important that we understand how the economy works and functions. And that's why I wrote the book and make the videos is because I think I think it's super important.
So, what advice would you have for someone, whether it's in economics or another domain, they want to get kind of this flywheel going that you have books, videos? What has surprised you to the upside? If you were advising yourself 2 or 3 years ago, you leave the capital group, you're not working for a corporation, you're trying to build your own brand, your own small media company, if you will. What advice, hacks would you give to somebody who says, all right, I really want to get into, I want to be an influencer or make money in child psychology? And what hacks, what advice can you give to people?
I mean, I think the biggest hack is caring a lot. That sounds so silly, but like you have to care. I actually get stopped by my friends if I talk about the economy too much because it's something that I'm really passionate about. And so like if we're out to dinner, I'll just be like, "Did you all see the Fed today?" And they're like, "Not right now." And so I do think you have to have like a deep care for what you're talking about, and you have to really want it. It's really bumpy starting your own business, and it's really scary. Like if this didn't work out for me, I would have failed and, like, there was nowhere to go. And so I think there's an element of drive that you have, and you
Fear.
have
Yeah.
yeah,
Yeah.
fear is a big part of it. I was scared silly. I mean, it's, like, funny now looking back on it because everything worked out, but I can think of exact moments where I could have quit and, like, could have stopped and could have given up, and you just have to push through that. And I would say that that would be the biggest advice is, like, caring a lot and, working through fear the best you can.
What about tactically? What platforms have made money for you? Where have you gotten the greatest return on investment in terms of raising awareness? Which platforms have had the lowest ROI?
So Twitter, previous Twitter before the new owner came in was where I got a lot of traction because there's a lot of amazing finance and economics people on there. And Instagram has been very good with reels and discovery. I'm really known for TikToks, but I actually don't have that big of a platform on TikTok. And I think that TikTok is dying. And then I have a newsletter
You think
as
TikTok
well.
is dying?
Yeah. I think it's
Say
gonna
more.
get yeah, well, I think it's just gonna be legislated away. I think somebody's gonna buy it maybe, but I think that, we're slapping tariffs on China. There's no way they're gonna let that app continue to exist. I think it'll be a post-election thing, like, depending on who gets elected, but yeah, yeah, I think that that's gonna go away.
So I'm off of Twitter. I just because I don't want to paint that guy's fence. What has happened for you at Twitter?
It's been sad. I really loved Twitter, and I still learn a lot on there, but I lurk more than I post now. There's still like really amazing economists and like really great thinkers, but you can see the influence of Elon on the platform, and the algorithmic incentives are toward doomerism and like the bad kind, where people are questioning reality and painting all sorts of colors on stuff that maybe shouldn't be painted, whatever. But, yeah, I think it's been sad to watch the decay of a platform, but it makes sense. In the internet age, everything turns over so quickly. The good times can only last for so long on certain places.
It's interesting. I tell people I would have naturally gone to TikTok as a place to overinvest, and you. It's interesting to hear your perspective. If someone was going to pick one platform to overinvest in right now to try and build a big brand footprint, what platform would you suggest?
I mean, I think TikTok still has discoverability, but Reels is now trying to compete with TikTok in a really big way, and I think their discoverability has improved tremendously. So I think Instagram actually has become a very good app to build a following on.
What about YouTube?
YouTube's hard. I haven't even really figured out YouTube actually. I think that you have to kind of play to the rules of the algorithm. Mr. Beast is, like, very good at this, which is why he has such a big platform, but you have to have, like, the right titles and the right thumbnail, and, I think that long form is just very hard to capture people within, and like, they are investing a lot in YouTube Shorts, and you can post shorts and I think do pretty well, but yeah, I think long form is just hard to get discovered on.
So, Kyla, you know why we invited you on this podcast?
Why was that?
Because you're very impressive. And
Oh, thanks.
I I thought to myself, we have all these financial experts on, and they all are the same goddamn person. They're all old guys on CNBC. And I think it's great that you've managed to establish this following. And when I hear you speak, I'm like, gosh, this person just gets it. So we're hoping that you're going to come back on and be a regular guest. But you really are. I was really inspired when I saw your content. I just thought it was so puncturing and, I don't know, down to earth and relatable. So well done.
Thank you. Yeah, that's the whole goal is to make accessible content. Like that was the goal of the book. Like there's 60 illustrations in there. Like it doesn't need to be as complicated as we make it. And I think that makes it so scary is like we make it so scary. And it is really just like nice, I think, to have somebody talking at you, I guess, about like the economy. There isn't a lot of that because there's a lot of gatekeeping, as you know. And yeah, I'm glad that it is helping people.
No, I think it is. Kyla Scanlon is a writer, video creator, and podcaster who focuses on educating her audience about the economy and the financial markets. Her debut book, In This Economy, How Money and Markets Really Work, is out now. She joins us from a WeWork in, are you in New York? Are you in Brooklyn? Where are you?
No, I'm in New York City, Manhattan. Yeah.
Oh, nice. Well, it's great to be here, and thanks for your good work, Kyla.
Yeah. Thank you so much.